learn how to read and understand cryptocurrency charts. My name is Kieran and I'm happy to have you here with me today. In this video, I'll try and explain the basics of cryptocurrency charts, and hopefully after this video, you will be able to improve your trading decisions. So let's cut to the chase, and I'll start with bearish and bullish moves, what that is. So in short, a bearish move is when the price of an asset goes down, so the charts are going down, and bullish is upwards move when the price is going up. So now about the principles and the things I'm going to be talking about this guide. There's a very strong overlap between traditional charts and the cryptocurrency charts. The main difference, like the biggest difference between both, is just the time where it's playing out. So on regular traditional assets, you're going to have a trading time. It could be like from 9 a.m. to 5 p.m. And the biggest difference with cryptocurrency charts is it's non-stop. You can trade all day, all night, 365 days a year. So the charts are always ongoing and they never stop. So that's the main difference. Apart from that, many technical analysis and chart knowledge that you take from traditional asset classes, you can also use it in cryptocurrency. It's more or less the same. So now, first of all, what's important to know is the Dow Theory. So the Dow Theory helps you have a better grasp on technical analysis, and the fundamental ideas behind Dow Theory are as follows. The market takes everything into consideration during its pricing. All existing prior and upcoming details have already been integrated into current asset prices. So at this moment in time, the price of an asset is as it should be based on supply and demand. Speculation is calculated into it, FOMO is calculated into it. At this moment in time, a price has everything is calculated into the current price. Furthermore, when it comes to cryptocurrency, the things that are considered are multiple variables like current, past, and future demands, and any sort of regulation that may impact the crypto market. At this moment in time, everything is calculated into the price. Next up, price movements are not exactly random. They follow trends more often than not, and it may either be a long or a short-term trend. Market analysts are focused on the price of a coin rather than every single variable that produces a movement in its price. You differentiate between technical analysis, and technical analysis is all about charts and the price movement. You don't look at the fundamentals, so the news that is happening and so on. So all in all, you can use both fundamental analysis and technical analysis, but more in this video is going to be about technical analysis. So the 6 tenets of Dow Theory, so 6 principles of Dow Theory are as following. The 3 movements of the market. These are the important movements of the market. You've got a long-term trend. This would be a bearish long-term downtrend. Then you can have a mid-term uptrend, which would be a bullish mid-term uptrend, as you can see here, and a bearish mid-term downtrend. And in these trends, you can have again some smaller short-term trends, which would be here, for example, this one here. Let me get my pen tool. This one here would be a bullish short-term trend, and this here would be a bearish short-term trend. So as you can see, you can have mid-term bullish trend during a long-term downtrend, and you can have multiple bullish and bearish short-term trends in a mid-term uptrend, for example. So the market is constantly moving and is you have to look at the different time frames. Here, as you've got the volume, long-term trend for volume is down, confirming major trend. As you can see, if you look at this chart, the price is going down. You've got lower highs and lower lows, and this is also reflected with the decrease in volume, as you can see here on this volume indicator. The primary movement is the main movement, which is a major trend and may last from a year to several years, decades, 20 years or even more. And this trend can be bullish or bearish. Then we have the medium swing, which is a secondary or intermediate reaction and may last from 10 days to 3 months. It generally traces from 33 to 66% of the primary price change. And finally, we have the short swing or minor movements, which varies according to market speculation. When we look at the market, there are 3 important market trends, and those are, you've got the accumulation phase, which is more of a sideways trading phase. Then you've got the absorption phase, which would be in a bullish trend, and the price is going up in a channel. And then after this absorption phase, you've got the distribution phase, where traders or long-term investors start taking profit and the price starts going down. So accumulation phase, this is the period when knowledgeable investors start buying or selling. This would be buying the dip, early investors. Absorption phase, eventually the market catches on to these intelligent investors. So this would be more like the FOMO phase. And distribution phase, after huge speculation, because of the limited supply of the asset, the price begins to retrace as the knowledgeable investors begin to distribute their holdings to the market. So in this phase, the early investors which accumulated here and maybe some that accumulated at the beginning will be diversifying their portfolio, either maybe selling their cryptocurrency for fiat or buying altcoins or other things. Number 3, the stock market discounts all news. The stock market incorporates new information as soon as it becomes available. And as soon as this news is released, the price of the asset changes to reflect this new information. Now, in cryptocurrency, this happens very fast. As soon as news hits different news channels, then the price reflects this news. If it's FUD, fear, uncertainty, doubt, then the price reacts negatively, and there is a dip. You see a dip in the charts, and the price starts to correct or crash depending on the nature of the news. If it's really something bad like a hack, then it's reflected terribly in the price. The stock market averages must confirm each other. So to understand how this works, consider this example. There's a company A and a company B. Suppose A is handicrafts company and B is a transportation company. A uses B's service to transport their products. Now, if A gets more business, then B will get more business as well. So if an investor is interested in investing in company A, they need to look at the performing of company B. Now, talking about the cryptocurrency market, the main pull fact, like the asset that has the largest pull on the whole cryptocurrency market is Bitcoin. Very many of the other cryptocurrencies are following Bitcoin's price movements. They've got a different correlation, but most often when Bitcoin makes a large price movement, then most other coins follow, and that's mainly to do with the fact that Bitcoin is a trading pair for many of the other cryptocurrencies. Trends get confirmed by volume. So Dow Jones believes that volume is a secondary yet very important factor in recognizing price signals. So during an uptrend, you want increasing volume constantly, and during a downtrend, the volume decreases with a decrease in price. Like we saw that before on this chart here. and here the price is decreasing, and you would want to see the same thing when the trend is going up. You want to see an increase in volume, also with such a slope, but more of a bullish slope. So the trends will exist until definitive signals prove that they have ended. And this principle is a lot like Newton's first law of motion. An object in motion tends to remain in motion unless acted upon by an external force. What he means by this is that you should be trend following. If there's no reason why the market should change direction, then just follow the trend. If the trend is bullish, then try and follow this bullish trend and don't swim against the current, as that will most likely mean less profits for you. To understand technical analysis, you might have seen some jokes or pictures about it. Here's a good one with basically this highlights the main view of what people think that technical analysis is just drawing lines on the chart, and it might look like a dinosaur or a Bart figure because of manipulation. And yes, there is manipulation in the market, and it's also very important to understand what technical analysts are trying to do. And the first thing they're trying to do is predict future price movement on a cryptocurrency pair or a stock, and it can be creative and dynamic, which helps gain a deep perspective into the market. Now, the idea that you're predicting the future is, first of all, it's very difficult to predict the future, and you're trying to find different price points where the statistical probability that the price is going to react at that price point is very high. So you're going to maybe look for support and resistance levels, like price points where you believe that the price is going to stop at that, the charts are going to stop at that price point and then maybe go back down again. But yeah, it's very difficult to predict future price movements, and very often technical analysts are wrong. But you try and make sure that more than 50% of your trades are correct, and then you're in the green. So there are different time frames for the cryptocurrency charts. When a technical analyst examines the price chart along with the technical tools, they also have to be mindful of the time frames. I mean, you could, in my opinion, I don't look at the 1 minute charts because they're much too fast. The most frequent ones to use are the 15 minute chart, the hourly chart, the 4-hour chart, and the daily chart to see long-term trends. And I also like to look at the weekly chart to see the very long trends, which one candle is going to be 1 week. So we're going to look at what candles are afterwards. If you're not sure about that, just wait and I'll explain that. So the time frame that you choose is of course important on what your goal is. If you are like an intraday trader, so you get into the market and you want to trade maybe for a few hours, then it makes more sense to use a 5 or a 15 minute chart and to find your positions and exit positions in the matter of a few hours. And if you're like a long-term trader, maybe a 2-hour or 4-hour chart would be enough for you to have a big picture of the whole market and also a little bit on what's happening in the day. Now, cryptocurrency market cap is an important term that you have to understand. And to calculate the cryptocurrency market cap, you use the total circulating supply of a coin times the price of each coin. So in other words, it is a product of the coin's circulating supply and the price of each coin. So let's take, for example, you've got a coin, it's got 300,000 coins in circulation at $2 a piece. And if you multiply the 300,000 times 600 times 2, then you've got a 600,000 US dollar market cap. Now, an important thing to note, and I've noticed it a few times, is the market cap is not a representation of how much money is in the market. Think about that for a second. The market cap is not a representation of how much money is in the market. It's a representation of how much the valuation of a coin is based on its price and circulating supply. That means I can create a market capitalization of 900,000 US dollars with this coin here by just buying one additional coin from the supply at $1 more. So if I buy this coin for $1 more, for $3, then what you would be doing is the price of the coin increases to $3, and you would do $3 times 300,000 coins, which would make a market cap of 900,000 US dollars. So with just $1, I would be creating an additional 299,000 US dollars on the total market cap of this coin. I think this is very important to keep in mind. I hope that was not too fast, but yeah, keep in mind that when you're looking at coin market cap and so on and the valuation, I could personally make my own cryptocurrency with 1 million circulating supply of coins, and I can buy one coin for $10, and then I've already got a 10 million US dollar market cap. So that's why it's very important to, first of all, look at the liquidity and the trading volume of different coins, because that shows how much is being traded. And if the liquidity is very low, then it's likely that someone just bought maybe one coin for a higher price, and that dramatically increased the market capitalization of that coin. So even though the things I just mentioned, it's still nice to look at the different market capitalizations, but I think it's important to keep that in mind, especially when people decide to sell, because there are probably many more sellers. There are many more buyers which bought maybe at $1 and they want to maybe then sell at $3. So you can imagine how fast the price per coin goes down as soon as many more people sell. As it's the same with supply and demand. Now, an important aspect of charts are the Japanese candlesticks. And what are Japanese candlesticks? You might have seen them before. They look like candlesticks with a wick. Here we've got the wick on the top, and here we've got the wick on the bottom. You've got a bullish candle and a bearish candle. So this here is a graph candlestick chart from BTC USDT on Binance, and here is a representation of what a candle is. And this is green. I like to use the color green. It's very often used as a bullish candle, and this is the structure of the candle. You've got at the bottom, you've got the wick, and this is a shadow, and here you've also got a shadow, which is also referred to as wick, and the fat part of the candle is called the body. Now with a bullish candle, the price starts at the lower end of the candle at the beginning. So let's say you're looking at a time frame of 1 hour. So at the beginning of the hour, the price is at this price point at the bottom of the candle, and at the end of the hour, at the last second, the price point is up here at the top end of the body of the candle. Now these wicks represent price movements in that hour. So for example, after half an hour, it's possible that the price maybe went up to the half and then fell down to the lowest part of this shadow and then went back up again. And the same with the top part of the shadow. So this is the maximum amount of price that this cryptocurrency had during the hour, and at the bottom part is the minimum amount that this cryptocurrency had as a price during that hour. But the beginning is at the bottom of the body, and the ending price is at the top of the body. Now the thing is with the bullish, the bullish candles are more or less the same. The biggest difference is that the price starts at the top at the beginning of the time frame and ends at the bottom. So the price during that hour has decreased in the coin during that hour has decreased in price, and it will be then at the bottom. If I can draw one here, rudimentary candle, just to highlight what I mean. And so basically here is the beginning at 11. The price is, for example, at 6,000 US dollars, and at the end of the so for example 11:59 and 59 seconds, at exactly at 12 a.m. so that would be here. The price would be then, it's a butchered 12. So the price would be here. That would be then the bullish candle. Now there are different important patterns that you can look for, which help indicate how the price will change for the next candle, what's going to happen in the next candle, so because that's what everyone wants to know. So the first candlestick that you can remember is the hammer pattern, and the hammer is a one candle pattern which has it's got a very little shadow here at the bottom, and the body is also relatively small. However, the wick is very, very long at the bottom. So the price at the top of the quarter is closest at the top of the quarter of the range, and the lower shadow is 2 or 3 times the length of the body. And a hammer is a bullish reversal pattern that forms after decline in price. So if you see the price of an asset go down, fall down, fall down, and then you see a hammer, this would be a hammer here. This would be something like a hammer. And here you've got a hammer, and as you can see, this indicates that there's going to be a short-term or even long-term reversal in trend. It's massive. All right. Next, you've got engulfing bullish pattern. And this is also a very, very strong one. So you've got here a bearish candle where the price stopped here at the bottom part of the body. And here you've got then this bullish candle where the price starts here again at the bottom part of the body, but ends much higher than the previous candle. And it's called engulfing because this candle is much bigger and engulfs the previous candle. The bullish engulfing pattern is a 2 candle pattern, and how to recognize it: the first candle is bearish and the second one is bullish, and the second one overwhelms the first one and covers it completely. And what this means: on the bearish candle, the sellers are in control, and on the second candle, the buyers are in control and show a potential reversal possibility. This is actually quite a good indicator because it shows that the bulls have more control at the current price. You've got number 3, morning star. So the morning star looks like a star. There's not much to say about it. A morning star is a 3 candle bullish reversal pattern which forms after a decline in price. And how to recognize it: the first candle is bearish. Then you've got this very small candle, more or less no body at all. And then you've got a bullish candle which is more or less the same size as the previous candle. And this means that here that the buyers now are in control of the market for this time frame. Bearish reversal patterns are very important. So the most common one is the shooting star. The shooting star is a one candle bearish pattern, and it's a reversal pattern. And how to recognize it: you've got a very small body, you've got a much longer wick shadow at the top, 2/3 of the shadow in comparison to the body. And this shows that here the bears are in control and push the price down, even though the bulls have tried to push the price all the way up here during this time frame, but the bears have pushed the price all the way down to the lower part of the body, where the price ends at the end of this time frame. What does this mean? The buyers took control of the market and opened and pushed the price high, and at the close there was a huge selling pressure from the bear. In short, a shooting star signifies a bearish reversal and shows that the sellers are coming in strong in the market. Furthermore, bearish engulfing pattern. So we've seen the bullish engulfing pattern. Now with the bearish engulfing pattern, it's more or less the same thing, but in reverse. So the first candle that you've got is a bullish candle, and the second candle is much bigger and is a bearish candle and encompasses the previous candle. So the bearish engulfing candle tells you that the sellers have overwhelmed the buyers and are now in control. So here the sellers have managed to push the price all the way down to here, and they are in control. Evening star. An evening star is a 3-candle bearish reversal candlestick pattern, and how to recognize it: it's got nearly no body. The first candle is a green candle, a bullish candle, and then afterwards comes a bearish candle, showing that the sellers are in control. Now, an important thing to note about these patterns is I really like to use them on higher time frames, for example on the daily, because it's something that is very strong, and you can use it to maybe identify changes in trend. As you can see here, you've got a hammer pattern forming on the daily trend on the 6th of June. So if you would have entered here after seeing this pattern, then yeah, you would have had a nice profit. But of course you won't be buying all at the low, so maybe you could also use the 4-hour time frame to maybe find some easier patterns to help you find good entries into the market. Alright, now RSI, Relative Strength Index. I think this is also an important indicator. We're moving away from candlesticks and moving into this index, which measures the strength and speed of a market's price movement by comparing the current price of a cryptocurrency to its past performance. And it works by comparing the magnitude of recent gains to recent losses to determine whether crypto has been overbought or oversold. So here's the formula. You can pause the video and look it up and see if it makes sense to you. But the easy thing, it's actually very easy to install. On Binance, you can click on indicators and click on RSI, and then you've got this RSI line where the 70 above the 70 range is then overbought, and under the 30 range is oversold. So the rule of thumb is you don't really want to be buying too much when the cryptocurrency asset that you're looking at is above the 70 range, and you don't really want to be selling this cryptocurrency asset when it's below the 30 RSI range, as that would mean you'll be buying at the top and selling the lows. So that's not something that you want to do. On TradingView, you can also here, you can click on indicators, and then you can search here for RSI, and here I've got the Relative Strength Index. I've already got it installed here on this chart, and I've tweaked it a little bit to make it look nice. And me personally, it's one of my favorite indicators to use, and it helps me look for hidden trends in the market which might not be obvious, but that would be reserved for our next video. So back here, the range, it ranges from 0 to 100, and as I mentioned before, when RSI for a particular coin approaches 70 or even crosses 70, then it is considered to be overbought, so also known as the crypto in question is getting overvalued. On the other hand, if RSI approaches 30, then the crypto is undervalued and oversold. While RSI is a pretty useful indicator, the truth is that it isn't immune to false buy and sell signals. Like with all indicators, I wouldn't just use one indicator, but use all different indicators so that you can have a bigger picture of what's going on in the market. Another important bit of information to know, and this is the basics, and that's support and resistance, and what we mean with support and resistance lines. So in technical analysis, support and resistance are predetermined levels of the price of an asset at which the trend tends to reverse its trend. These levels are denoted by multiple touches of the price without a breakthrough of the level. So here we've got a nice example of a support. A support level is where the price of an asset tends to stop falling. So it's nice to know where the support levels are. And to find out where support levels are, you can look at previous price action and look where the price stopped at a certain level and had a small reversal and maybe touched this level again. The more touch points you're going to have on a support level, the stronger this support level is going to be. Now a support level, should it be breaking, if the price manages to break past this support level, then it will become a resistance, as we've got this example here. So at the moment, there was a few days or weeks ago, the price was bouncing around and touching the support level of $3,800, and the $3,800 range was acting as a support. Now the price managed to break past this support level, and when the price breaks past the support level becomes a resistance, and as you can see here, the price goes back up and tries to touch the $3,800 range, doesn't manage, goes back down, tries to touch it again, doesn't manage, goes back down, and does it multiple times until it manages to break past. So as long as it can't break past this $3,800 range, is acting as a resistance, and when it breaks past this resistance, should become support. And it becomes support as soon as it gets tested again, as you can see here with this wick, and here with these two candles. As here we've also got a nice example of a bearish candle, and then you've got a bullish engulfing candle right afterwards. Now for if the sellers are carrying enough momentum and actually manage to breach past this level, the price will continue falling until it reaches another support level. So you've got multiple support levels that you can have, and the price might stop at one, might bounce around there to see if this is a strong support level. If it's not strong enough, then it will break down again and look for the next support level, and so on. So there are multiple support levels on different time frames. Some are much stronger than others. Yeah, that's what an important thing to know. Now resistance, the same is resistance is mainly the same thing, just the opposite way as I mentioned before. So with resistance, the price is rising and then just can't get past this certain point, and that would be the resistance level. In this case here, it's $4,300 range, the price goes back down, tries to go back up again, and fails to break past this resistance, as the sellers here are the bears here are very strong. So the price goes back down again, and then also again he tries again to break past, and so on. So the resistance is a set price where the candles can't manage to break past. The bulls can't push the price higher than this price point. So if we go here on our chart, we can maybe look for different support and resistance lines, and maybe this might help you be able to draw them in on your own. So what I like to do is I like to look for let's go on the 1 day, the daily time frame, and look for some support levels that we might have. Let's see. So here would be a good support level. Here with the horizontal line, it's in gray, so I'll change the color to light blue. It's a bit more. As you can see here, this is a pretty strong support level, and that's at the 6,100 US dollar range. We've got multiple touch points on the support level. We've got one here, one here, a small breakthrough but recovery here. Make this a little bit bigger so that you can see it. And then another support and touch point here. So the more support and touch points we have on this support level, then the stronger this support level will be. And yeah, you can count them and so on. Now, unfortunately, we broke past the support level on the 14th of November 2018. You might have noticed it. And here, luckily, we managed to break past. Now, this was supposed to act as a very strong resistance, but we didn't have that many touch points, so we just broke past this support level, this resistance level without really, it wasn't actually a resistance level. But now what we can hope, should the price now correct and go down, we can hopefully have this as a very strong support level where we can put our buy orders, because just putting buy orders randomly, it's pretty difficult because you don't want the price to sink after you bought. Many people go like, oh, the market just crashed because I bought $10 worth of Bitcoin. Yeah, so it's important to have different support levels where you can put your buy orders. Here's also a quick example of another support level. It's got a much less touch points, but in my opinion, it's still quite a strong level, and that will be at the 7,600 US dollar range. Here you've got 1 touch point, 2, 3, 4 touch points on this support level. Yeah, so here you could use this as a buying range to maybe increase your position. All right, now something that's important to know are the participants in the market. So the different participants are the traders who are going long and waiting for the price to rise, traders who are going short and waiting for the price to fall, and traders who are not really sure what's happening and just go in. So price, when it's rising from support, when the price bounces off of the support level and goes up, the 3 participants react like this. The traders who are going long are happy with the state of the market. They may also try to add even more to the position. The traders who are going short may second guess their position and try to buy in more to break even as the price reaches the support level again. So they might be closing the position, or they might even get liquidated and there is a short squeeze, which means that the price, the people that are short have to buy back in, which pushes the price much faster higher. Alright, so when the price falls through support, the same thing happens, just another way. The traders who go long start to panic and they may sell, causing the price to go down much faster. And those that are short, they're happy and they might sell more to increase the position and gain more profits. Now, support and resistance, you can look at that as market emotions, the global aspect. It's basically a line where the supply and demand, where traders, buyers and sellers find an equilibrium price point where they are, where the price more or less stays stable. So the biggest factor behind price movements are emotions like fear, greed, optimism and pessimism. And you can think of a price chart as a graphical representation of that. So the reason why emotional price levels like support and resistance are so significant is that they attract a lot of attention and create anticipation, and this attention attracts a large number of volume and traders. So what actually can also happen is if there's a very strong support here, for example the 6,100 US dollar level, and the price starts falling, and many people, they don't want to start buying here because they expect the price to fall down to the 6,100 US dollar level. So they'll be putting their price, the buy targets around this area. But what will probably happen is the price reaches maybe the 6,300 US dollar level, and so many people are anticipating that the price will go to 6,100 that they already start buying here because they think that there will be too many buyers down there, and the price never actually reaches this support level because of the emotions of the market. So that was it for today. Hopefully you learned something new on this basics, really basics guide on how to understand how cryptocurrency markets work. Hopefully you can use some of these tools to improve your trading or just actually reading charts. Now what I can suggest you to do is you can head over to TradingView. You can make a free account and you can look at other traders and what they're doing on TradingView, what their opinions are on the market. You can follow them and try and learn with their trading style and trading strategies, and hopefully learn what kind of indicators they are using and so on. So you can here on TradingView, you can look at their ideas and try and learn from how they use the different indicators and what the predictions are. Look and see if the predictions are correct and try and learn from them. They will be talking about many different topics, and they use terminology which is very important in technical analysis. So here there's a good example from Bill Charlson where he's using exponential moving averages, and he's saying where he believes the price will bounce. He's got some support and resistance lines drawn in and so on. Remember that it's still a type of speculation. Nothing is guaranteed, so don't put all your money into one single trade. Learn a little bit about risk management, and that's about it. So that was it for this video. I hope you had a good time, and I'll see you on the next one. Bye bye.